movements of my own stocks, I reasoned that if the average was going up, so would my stocks. Soon after, I found out that this was not true. To try to fit the market into a rigid pattern was a mistake. It seemed quite impossible to do it. Each stock behaved differently. There was no such thing as a mechanical pattern. I was wrong many times before I banished the average to its proper place. It was some time before I discovered that the Dow Jones Company publishes an average. It simply mirrors the day-to-day behavior of 30 selected stocks. Other stocks are influenced by it, but do not mechanically follow its pattern. I also began to appreciate that the Dow Jones Company is not a fortune-telling organization. It does not attempt to tell you when individual stocks will rise or fall. Gradually, I began to understand that I could not apply mechanical standards to the relationship between the average and individual stocks. Judging this relationship was much more like an art. In some ways, it was like painting. An artist puts colors on a canvas obeying certain principles, but it would be impossible for him to explain how he does it. In the same way, I found that the relationship between the average and my individual stocks were confined within certain principles, but they could not be measured exactly. From then on, I made up my mind to keep watching the Dow Jones Industrial Average, but only in order to determine whether I was in a strong or a weak market. This I did because I realized that a general market cycle influences almost every stock. The main cycles, like a bear or a bull market, usually creep into the majority of them. Now that I was armed with a finishing touch to my theory, I felt much stronger. I felt as though I was beginning to touch some of the light switches which would illuminate the room. I discovered I could form an opinion on the stocks from the telegrams in front of me. They became like x-rays to me. To the uninitiated, an x-ray picture is meaningless, but to a physician, it often contains all the information he wants to know. He relates its findings to the nature and duration of the illness, the age of the patient, etc., and only then does he draw his conclusions. Looking at my telegrams, I did something similar. I compared the prices of my stocks first with each other, then with the Dow Jones average, and after I weighed their trading range, I evaluated whether I should buy, sell, or hold. I did this automatically without deeper analysis. I could not fully explain this to myself until I realized that I was now reading and no longer spelling out the alphabet. I was doing what an educated adult does. I could absorb the printed page at a glance and draw rapid conclusions from it, instead of painfully putting the letters together like a child. Simultaneously, I tried to train my emotions. It worked this way. Whenever I bought a stock, I wrote down my reason for doing so. I did the same when I sold it. Whenever a trade ended with a loss, I wrote down the reason I thought caused it. Then I tried not to repeat the same mistake. This is how one of my tables looked. Bland Creek Coal, bought 46, sold 43.5. Cause of error, bought too late. Joy Manufacturing, bought 62, sold 60 and an eighth. Cause of error, stop loss too close. Eastern Gas and Fuel, bought 27 and 3/4, sold 25 and 1/8. Cause of error, overlooked weak general market. Alcoa, bought 118, sold 116 and a half. Cause of error, bought on decline. Cooper Bessemer, bought 55 and 3/8, sold 54. Cause of error, wrong timing. These cause of error tables help me immeasurably. As I drew them up one after the other, I was learning something from each trading. I started to see that stocks have characters just like people. This is not so illogical, because they faithfully reflect the character of the people who buy and sell them. Like human beings, stocks behave differently. Some of them are calm, slow, conservative. Others are jumpy, nervous, tense. Some of them I found easy to predict. They were consistent in their moves, logical in their behavior. They were like dependable friends. And some of them I could not handle. Each time I bought them, they did me an injury. There was something almost human in their behavior. They did not seem to want me. They reminded me of a man to whom you try to be friendly, but who thinks you have insulted him, and so he slaps you. I began to take the view that if these stocks slapped me twice, I would refuse to touch them anymore. I would just shake off the blow and go away to buy something I could handle better. This does not mean, of course, that other people with a different temperament from mine were not able to get on well with them. Just as some people get along with one set of people better than they do with others. The experience I gained through my cause of error tables became one of the most important of all my qualifications. I now realized I could never have learned it from books. I began to see that it is like driving a car. The driver can be taught how to use the accelerator, the steering wheel, and the brakes, but he still has to develop his own feeling for driving. No one can tell him how to judge whether he is too close to the car in front of him or when he should slow down. This he can only learn through experience. As I flew around the world and operated in Wall Street by cables, I slowly came to see that though I was becoming a diagnostician, I could not be a prophet. When I examined a stock and found it strong, all I could say was, it is healthy now, today, at this hour. I could not guarantee it would not catch a cold tomorrow. My educated guesses, no matter how cautious they were, many times turned out to be wrong. But this did not upset me anymore. After all, I thought, Who was I to say what a stock should or should not do?
Right.
Even my mistakes did not make me unhappy.
space.
If I was
Take the
right,
right.
so much the better. If I was wrong, I was sold out. This happened automatically as something apart from me. I was no longer proud if the stock went up, nor did I feel wounded if it fell.
Here's the
I knew
way,
now that the
Daddy.
word value cannot be used in relation to stocks. The value of a stock is its quoted price. This in turn is entirely dependent on supply and demand. I finally learned that there is no such thing as a $50 stock. If a $50 stock went to $49, it was now a $49 stock. Being thousands of miles away from Wall Street, I succeeded in disassociating myself emotionally from every stock I held. I also decided not to be influenced by the tax problem. Many people hold on to stocks for 6 months to obtain long-term capital gain. This I consider dangerous. I might lose money by holding on to a falling stock just for tax reasons. I decided I would trade in the market by doing the right thing first, follow what a stock's behavior commands, and care about taxes later. As if stocks were made to confirm my new attitude, I handled them successfully for quite a while. I bought with bold confidence when I thought I was right, and coldly, without hurt ego, I took my limited losses when I thought I was proven wrong. One of my most successful operations was in Cooper Bessemer. I bought 3 times into this stock, each time 200 shares. 2 operations ended with a loss, but the third made me a sizable profit. Here are the details of these purchases. November 1956, bought at 46, $9,276. Sold at 45 1/8, $8,941.09. December 1956, bought at 55 3/8, $11,156.08. Sold at 54, $10,710.38.
3 days.
January to April 1957, bought at 57, $11,481.40. Sold at 70 3/4, $14,056.95. A few other stocks, like Dresser Industries and Reynolds Metals, behaved equally well and gave me satisfactory profits. But then, in the summer of 1957, when I was in Singapore, a most staggering series of events developed. I bought Baltimore and Ohio Railroad at 56 1/4. I thought it was in the 56.61 box and it would advance, but it started reaching down and I sold it at 55. Then I tried Dobekmund. I judged it was in a 44.49 box, so I bought it at 45. It began to sag and I sold it at 41. I bought Daystrom at 44 because I thought it was rising into the 45.50 box. I sold out at 42 1/4. I bought Foster Wheeler at 61 3/4. I thought it was in the 60.80 box. When it turned slowly against me, I sold out just below 60 frame at 59 1/2. Aeroquip was the last one. I had bought it at prices ranging from 23 1/4 to 27 5/8. I watched it climb towards 30 and waited for the 31.35 box to evolve. It did not happen that way. I was stopped out of Aeroquip at 27 1/2. Finally, on August 26, 1957, I found myself without a single stock. My automatic stop loss had sold me out of everything. In 2 months, every one of my stocks had slowly turned around, and one by one had sagged through the bottom of their boxes. And one by one, even if it was only a question of half a point, they were sold. I did not like it, but there was nothing I could do. According to my theory, I just had to sit back and wait patiently until one or more of the stocks I had been stopped out of, or any other stocks I was watching, went towards a new higher box. Eager and anxious, I watched from the sidelines with not a dollar invested, while prices continued to drop. But no opportunity seemed to appear. What I did not know was that we were at the end of one phase of the great bull market. It was several months before this became evident, and it was declared a bear market. Half the Wall Street analysts still discuss it. They say it was merely an intermediate reaction, a temporary halt in the rising market. They all agree, however, that prices collapsed. Of course, all these opinions are expressed by hindsight, when it is too late. The advice to get out of the market was not available when one needed it. I recall the case of Hitler when he decided to invade Stalingrad. To him, it was just another Russian town to be conquered and occupied. Nobody knew while the Battle of Stalingrad was being fought that it was the turning point in the war. For a very long time, few people realized it. Even when the German armies were halfway back, it was still talked about as strategic withdrawal. It was, in fact, the end of Hitler. The Nazi war bull market ended the day Hitler attacked Stalingrad. In the same way, I realized that it was impossible for me to assess great historical turning points in the market when they began to happen. What fascinated me as Wall Street prices continued to fall was the gradual realization that my system of ducking out quickly with my stop losses made such an assessment unnecessary. I made the joyful discovery that my method had worked much better than I had dreamed. It had automatically released me well before the bad times came. The market had changed, but I was already out of it. The most important aspect to me was that I had absolutely no hint whatsoever that the market would slide. How could I have had any information? I was too far away all the time. I had listened to no predictions, studied no fundamentals, and heard no rumors. I had simply gotten out on the basis of the behavior of my stocks. Later, when I studied the stocks I had sold automatically, I found that they had subsequently slid down very low indeed in the recession period. Look at the following table. Baltimore and Ohio. 1957, I sold at 55. 1958, lowest price, 22 and 5/8. 1956, highest price, 45 and a quarter. Daystrom, I sold at 42 and a quarter. Lowest price, 30. Highest price, 39 and 3/4. Foster Wheeler, I sold at 59 and a half. Lowest price, 25 and an eighth. Highest price, 39 and an eighth. Aeroquip, I sold at 27 and a half. Lowest price, 16 and 7/8. Highest price, 25 and 3/4. Allied Control, I sold at 48 and a quarter. Lowest price, 33 and a half. Highest price, 46 and a half. Dresser Industries, I sold at 54 and a half. Lowest price, 33. Highest price, 46 and 5/8. Joy Manufacturing, I sold at 68. Lowest price, 38. Highest price, 54 and a half. Allegheny Ludlam, I sold at 56 and a half. Lowest price, 30 and an eighth. Highest price, 49 and 3/8. When I looked at this table, not taking me out of the market, I could have lost about 50% of my investment. I would have been like a man in a cage, locked in with my holdings and missing my opportunity to make a fortune. The only way been by smashing out, taking a 50% loss, possibly ruining myself and gravely impairing my confidence for future deals. I could, of course, have bought these stocks and put them away. This is a classic solution among people who call themselves conservative investors. But by now, I regarded them as pure gamblers. How can they be non-gamblers when they stay with a stock even if it continues to drop? A non-gambler must get out when his stocks fall. They stay in with the gambler's eternal hope of the turn of a lucky card. I thought of the people who paid $2.50 for New York Central in 1929. If they were still holding it today, it was worth about $27. Yet they would be indignant if you called them gamblers. It was in this mood of non-gambling that I received my monthly statement in the first week of September 1957, and I began to check up on my accounts. I found I had made up the money I had lost on Jones and Laughlin, and my original capital of $37,000 was almost intact. Many of my operations had been moderately successful, but commissions and taxes had taken a great deal. When I went into the accounts more closely, I found the unenviable distinction of coming out of the greatest bull market in history with a lot of experience, a great amount of knowledge, much more confidence, and a net loss of $889. Chapter 6. During the baby bear market. After a few weeks of being without a single share, I decided to take a closer clinical look at the situation. To understand it clearly, I made a comparison between the two markets. The bull market I saw as a sunny summer camp filled with powerful athletes, but I had to remember that some stocks were stronger than others. The bear market, the summer camp had changed to a hospital. The great majority of stocks were sick, but some were more sick than others. When the break came, almost all of the stocks had been hurt or fractured. It was now the question of estimating how sick the stocks were and how long their sickness would last. I reasoned that if a stock has fallen from 100 to 40, it will almost certainly not climb up to the same high again for a long, long time. It was like an athlete with a badly injured leg who would need a long period of recuperation before he could run and jump again as before. There was no doubt in my mind now that I could not make money by buying a stock and then trying to cheer it on. Jones and Laughlin had convinced me of that. I could remember how I almost felt myself willing and pushing that stock upwards. It was a very human feeling, but it had no effect upon its market any more than spectators have on a horse race. If one horse is going to win, it will win, even if thousands of onlookers are cheering for another one. It was the same now. I knew that if I bought a stock and turned out to be wrong, all the cheering and pushing in the world would not alter the price half a point. And there was no telling how far the market might fall. I did not like the trend, but I knew it was no use trying to fight it. The situation reminded me of George Bernard Shaw's remark at the opening night of one of his plays. After the curtain fell, everyone cheered and clapped except one man who booed. GBS went up to him and said, "Don't you like my play?" The man replied, "No, I don't." Whereupon Shaw said, "Neither do I. But what can the two of us do against all that crowd?" So I accepted everything for what it was, not what I wanted it to be. I stayed on the sidelines and waited for better times to come. I firmly refused to trade, so emphatically that my broker wrote to me and asked the reason. I tried to explain it by making a joke. This is a market for the birds. I see no reason why I should be in a bird market. The period that followed, I spent like a runner limbering up for the race. Week after week, while I did not have any stock and the market was in a steady downtrend, I followed the quotations and barons. I tried to detect those stocks that resisted the decline. I reasoned that if they could swim against the stream, they were the ones that would advance most rapidly when the current changed. After a while, when the first initial break in the market wore off, my opportunity came. Certain stocks began to resist the downward trend. They still fell, but while the majority dropped easily, following the mood of the general market, these stocks gave ground grudgingly. I could almost feel their reluctance. On closer examination, I found the majority of these were companies whose earning trends pointed sharply upward. The conclusion was obvious. Capital was flowing into these stocks, even in a bad market. This capital was following earning improvements as a dog follows a scent. This discovery opened my eyes to a completely new perspective. I saw that it is true that stocks are the slaves of earning power. Consequently, I decided that while there may be many reasons behind any stock movement, I would look only for one: improving earning power or anticipation of it. To do that, I would marry my technical approach to the fundamental one. I would select stocks on their technical action in the market, but I would only buy them when I could give improving earning power as my fundamental reason for doing so. This was how I arrived at my techno-fundamentalist theory, which I am still using today. As to the practical application, I decided to take a 20-year view. That did not mean I wanted to hold a stock for 20 years. Nothing was more contrary to my intentions. But I looked out for those stocks which were tied up with the future, and where I could expect that revolutionary new products would sharply improve the company's earnings. Certain industries were obviously at once, like electronics, missiles, rocket fuels. They were rapidly expanding infant industries, and unless something unforeseen happened, their expansion should soon be reflected in the market. From my research into the history of the stock market, I knew that the basic principles governing stocks of the future have always held good in Wall Street. In the years before automobiles, the smart operators went into railroads because they knew these would supersede the covered wagon and the stagecoach. A generation or so later, the shrewd investors moved out of the railroads into automobiles. Forward-looking, expanding companies like General Motors and Chrysler were comparatively small firms then, but they represented the future. People who bought into them at that time and stayed with them during their expansion period made a lot of money. Now these are well-established stocks. They are not for the forward-looking speculator. It is the same today, I reasoned. On the general theory of the buoyant future, stocks, which promise dynamic future development, should behave much better than others. A sound stock, which is in tune with the jet age, might be worth 20 times as much in 20 years. I knew that in this kind of stock, there were definite fashions just as there are in women's clothes. And if I wanted to be successful, it was important to search for fashionable stocks. Women's fashions alter, and so do fashions in stocks. Women will raise or lower their hemlines 1 or 2 inches roughly every 2 or 3 years. The same with stocks. While the fashion persists, the forward-looking investors get in and stay in. Then slowly the fashion fades and they are out. They are putting their money into a new style stock. I knew I must watch eagerly for these fashion changes, or I might be left still holding a long skirt stock when the new stocks were showing their needs. I might also miss, unless I was very alert, something sensationally new like the big bosom error. This is not so fanciful as it may seem. Take a mythical product like an automobile, which can also fly. Everybody is rushing for that company's stock. Yet in a converted stable in Oregon, 2 men are working on an invention, which will far outclass the flying car. Once that is ready for the market and a company has been formed to handle it, the original flying car will be superseded. Its stock will start to slide. It will become old-fashioned. This is an oversimplification and does not solve the problem. How to buy into this year's fashion? I can only do it by carefully watching the market for signs. If the fashions seem to be moving away from the long skirt, there must be some other about to be fashionable stock ready to take its place. What I had to do was to find stocks that would be hoisted up because they stirred people's imagination for the future. On the basis of this thinking, I carefully watched stock market quotations in this general bracket of expanding stocks in tune with the jet age. I was not interested in the company's individual products, whether it was metals for rockets, solid fuel, or advanced electronic equipment. In fact, I did not want to know what they made. I did not care what the company's products were, any more than I was influenced by the fact that the board chairman had a beautiful wife. But I did want to know whether the company belonged to a new vigorous infant industry and whether it behaved in the market according to my requirements. This, of course, was directly against the advice of many financial writers with conservative backgrounds who have been pounding into investors for generations that they must study company reports and balance sheets, find out all they can about a stock's background in order to make a wise investment. I decided that was not for me. All a company report and balance sheet can tell you is the past and the present. They cannot tell the future, and it was for this I had to project my plans. I also humbly realized that that was only my attitude. I was looking for capital gain. A widow looking for dividend income had to think otherwise. As I flew around the world, I was constantly searching for stocks that would climb into the stratosphere because of the vision of their future. This attitude was a preparation for what I suppose you could call high territory trading.
How
I
much
looked for
time
stocks
left
that I
in
thought
there?
could make new highs, and I
15
decided to give them my full attention when they had climbed onto the launching pad and were preparing to rocket up. Now, these stocks would be more expensive than ever before, and so they would look too dear to the uninitiated. But they could become dear. I made up my mind to buy high and sell higher. Using my hard-bought training, I diligently attempted to find these expensive but cheap, high-velocity stocks. I searched constantly for them because I felt sure that they would move up at the first sign of a better market. I carefully watched a dozen stocks, which seemed to be in this category, checking their quotations every week, analyzing their behavior for any sign of a hardening. I closely observed their price action, and I was on the alert for any unusual activity as well. I had not forgotten the importance of volume. I also prepared myself to operate in higher-priced stocks. This was because of the brokerage commissions. When I examined the rates, I discovered that it was cheaper to invest $10,000 in a $100 stock than in a $10 stock. Here's why. Let us suppose I wanted to invest my $10,000 in one stock. I could do it in several ways. For instance, I could buy 1,000 shares of $10 stock, or 500 shares of $20 stock, or 100 shares of $100 stock. The New York Stock Exchange commission rates were price of stock, $1, commission per 100 shares, $6. Stock $5, commission $10. Stock $10, commission $15. Stock $20, commission $25. Stock $30, commission $30. Stock $40, commission $35. Stock $50, commission $40. Stock $100, commission $45. To invest my $10,000 would cost me, buying plus selling, in the case of the $10 stock, $300. In the case of the $20 stock, $250. In the case of the $100 stock, $90. In the case of the $20 stock, $250. In the case of the $100 stock, $90. If my buying point was correct, the broker's commission was not important. It came off my profit. But if my timing was wrong and I was stopped out, that was another matter. Then the two commissions, one for buying and one for selling, had to be added to my loss. So you see, my mistakes would be much less costly if I bought higher priced stocks. As I watched the market continually sinking, I knew that it could not sink forever. Sooner or later, stocks would begin to move upwards. They always had. Bear markets were always followed by bull markets. The educated art was to watch for the first signs. Be sure they were real, and buy in before everyone else noticed and the prices began to rise too high. My mind went back to the Battle of Waterloo. At this famous battle, Rothschild had an agent who, as soon as victory was certain, set off for London and informed Rothschild. Rothschild started buying every British government share he could before anyone else heard the news. When they did, of course, the shares rocketed, and Rothschild sold at a huge profit. The principle remains the same on Wall Street today. Communications are much quicker, but the ancient art remains the same. To get in faster than the other fellow. That was the position for which I had now trained myself for 5 years. I knew I had learned an enormous amount. My Canadian period taught me not to gamble. My fundamentalist period taught me about industry groups and their earning trends. My technical period taught me how to interpret price action and the technical position of stocks. And now I reinforced myself by piecing them all together. It was like the solution of an intriguing jigsaw puzzle where finally all the pieces fall beautifully into place. I was certain this method would prove successful in the future. I felt calm and confident, waiting for the market tide to turn. After a few months, what I was waiting for began to happen. Reading Barron's, I noticed that while the averages were still showing a decline, as they had for several months, a few stocks were beginning to peep up, almost as unnoticeable as primrose buds on a winter's day. It was still a question whether these tender shoots would survive or be killed by frost. But when I noticed this slow awakening, I began to sense the end of this baby bear market, at least for certain stocks. I did suspect one thing, however, and that was that the leaders in the previous market would probably not lead again. I felt sure they had fulfilled their place in history and they would not, for the time being, reach the same dizzy heights that had brought so much money to the investors who had followed them. I had to find new ones. Later, this was proved right because hidden away in the market quotes during this period were some stocks which were apparently of not much interest to anybody. At that time, November 1957, they were certainly of no interest to me. I had hardly heard of them. They were Universal Products, quoted at 20, Thiokol Chemical, quoted at 64, Texas Instruments, quoted at 23, Zenith Radio, quoted at 116, Fairchild Camera, quoted at 19. These stocks were not dead. They were only sleeping the promising sleep of the unborn. One day soon, they were destined to wake up. They were going to leap into a new leadership of the market. They were going to make me $2 million.
That's how we made $2 million.
Chapter 7. The theory starts to work. While most Wall Street stocks drifted and dropped, I continued my dancing tour of the world. In November 1957, I was appearing at the Arkansas in Saigon when I noticed in Barron's a stock unknown to me called Lorillard. I did not know then that they were the manufacturers of a particular brand of filter tip cigarettes, and the filter tip craze was about to sweep America, causing their production to leap up astronomically. Out in Saigon, all I knew was that Lorillard began to emerge from the swamp of sinking stocks like a beacon. In spite of the bad market, it rose from 17 until, in the first week of October, it established itself in the narrow box 2427. Its volume for that week was 126,700 shares, which sharply contrasted with its usual 10,000 shares earlier in the year. The steady rise in price and the high volume indicated to me that there was a tremendous interest in this stock. As for its fundamentals, I was satisfied as soon as I found out about the wide acceptance of their Kent and Old Gold cigarettes. I decided that if it showed signs of going above 27, I would buy it. I asked my broker to cable me daily quotes. It soon became clear from these quotes that certain knowledgeable people were trying to get into this stock in spite of the general state of the market. Few people at that time had the faintest indication that Lorillard was to make Wall Street history, that it was to shoot up to a most astounding high in a relatively short time, watched by the amazed and gasping financial community. We were at the depth of the baby bear market, and the atmosphere was rather gloomy. But as if unperturbed by the general pessimism, Lorillard was happily jumping up and down in its little cage. By mid-November 1957, it became even more independent, and it began to push upward toward what I estimated would be a 2732 box. This isolated strength in the face of general weakness was very impressive to me. I felt I had sufficient proof of its strength, and I decided to become a bull in the bear market. I sent the following cable from Bangkok. Buy 200 Lorillard, 27.5 on stop, with 26 stop loss. As you see, although I felt quite secure in my judgment with my merged technical and fundamental viewpoints, I did not for one moment consider abandoning my chief defensive weapon, the stop loss order. No matter how well built your house is, you would not think of forgetting to insure it against fire. Within a few days, I received confirmation that I had bought 200 Lorillard at 27.5. I was well satisfied with my purchase and braced myself for the big rise. This came, but not the way I had assessed it. My first experience was disheartening. On Tuesday, November 26th, the stock dropped back exactly to my stop loss of 26, and I was sold out. To add insult to injury, seconds after I was stopped out, it started to rise and closed at 26 3/4. However, the reaction was so short and the rise that followed so firm that I decided to go back into it. That same week, I bought back my shares at 28 3/4. Again, I fixed my stop loss at 26. But this time, Lorillard's behavior was perfect. As the days went by, I was satisfied to see that the quotations never came close to my stop loss. This was a firm indication that I was on the right track, and that my theory applied to this stock. I happened to be right. In December 1957, Lorillard rose over 30 and made a new 3135 box. My experiences with similar stock movements in the past told me that it was being accumulated. I felt I had the right stock. Now it was a question of getting into it with more money at the right time. I carefully watched my daily quotes. I looked for the right moment, as a fighter looks for an opening to land his blow. Towards the end of January, after a false move, the big surge through which I had been expecting occurred. Lorillard started to move decisively out of its box. This seemed to be the ideal moment. Everything was encouraging. The technical action, the fundamentals, the pattern. Also, the New York Stock Exchange had just lowered its margin requirements from 70% to 50%. This meant that my limited capital now had much more purchasing power. Every $1,000 could buy $2,000 worth of stock. This was important to me because I needed my funds for another stock I was watching at that time. I was flying from Bangkok to Japan. It was from there I sent out my cables to add a further 400 shares to my holdings. These were bought for me at 35 and 36.5. In the weeks that followed, the stock's behavior continued to be exemplary. It was exciting to watch my theory being vindicated in practice. While I was traveling around the world dancing, Lorillard was steadily dancing about in its box. I would do this for a short time, and then, with an impeccable, almost predictable thrust, move into the box above. Lorillard boxes began piling on top of each other like a beautifully constructed pyramid. I watched them fascinated. I had never seen a stock behave so perfectly as this. It was acting as though my theory had been built around it. On February 17, 1958, Lorillard bounced up to 44 3/8. I was feeling very pleased with myself and the stock when 2 days later, I received a cable in Tokyo which frightened me. In one single day, my stock had dropped to a low of 36 3/4 and closed at 37 3/4. I was baffled. This move was completely unexpected. I didn't know how to explain it. I rapidly cabled New York and raised my stop loss to 36, less than 2 points below the day's closing price. I felt if it dropped there, I would be sold out and still make a nice profit on my first purchase. As I was in Tokyo, I could not know the Wall Street rumors which had driven the stock down that day. All I knew was that it acted badly. Later, I found out that there had been a report saying that
Independence.
filter tips were not so efficacious against lung cancer as they were claimed to be, and this had panicked a lot of people out of the stocks. Fortunately, the setback was very
Yes.
short and my stop loss was not touched off. This convinced me of the stock's power, and I decided to buy an additional 400 shares. I paid 38 and 5/8. Almost immediately, we left this price behind. The quotes came in 39 and 3/4, 40 and a quarter, 42. I was very happy. I felt as if I had become a partner in an immense new development. Everything looked as if I had planned it. It was at this time that I received from my broker 3 weeks' issues of a well-known advisory service. Week after week, this service strongly urged its subscribers to sell Lorillard short. The third recommendation read like this. Lorillard was obviously under distribution around 44 last week after we told you to start it on the short side. This amazed me, but I had long ago become so disillusioned with advisory services that I did not pay attention to it. Instead, I started to recommend Lorillard to any American tourist who mentioned stock market to me. I was genuinely trying to be helpful. My enthusiasm is best illustrated by what happened one day in the Erewhon Hotel in Bangkok. One afternoon at lunch, I was introduced to the president of one of the largest American shipping companies. During our conversation, he mentioned that his holdings in the stock market amounted to $3 million. They were broken up in the following way. $2,500,000 worth of Standard Oil, New Jersey. $500,000 worth of Lorillard. What do you think about it? He asked. What did I think of it? He could not have asked a better man. I immediately told him to sell all his holdings in Jersey Standard and switch his funds into Lorillard. That was what I would have done. A year later, I met him at a party in New York. Lorillard was then above 80. What's your latest stock market advice? He asked me. Advice? I said. I was astonished. Wasn't that $3 million worth of advice I gave you in Bangkok enough? It would have been, he said, if I had followed it. In the third week of March 1958, Lorillard entered on an even more definite upward thrust. It jumped 4 1/8 points in 1 week. Its volume increased to an astounding 316,600. And it established itself decisively in the 50-54 box. In the second week of April, Lorillard left its new box. It pushed through to a new high of 55 1/4, but immediately dropped back to its former 50-54 box. As I did not contemplate a further purchase, this did not upset me unduly. However, I cautiously raised my stop loss to 49. I also wavered for a moment on the verge of selling, but I decided against it. By now, I had trained myself to be patient, and although I could have taken an easy $20 per share profit on my earliest purchase, I sat back determined not to take too quick a profit. The cost figures for Lorillard were 200 shares at 28 1/4, $5,808.76. 200 shares at 35, $7,065. 200 shares at 36
We're close.
$7,366.50. 400 shares at 38 3/8, $15,587.24. Total $1,000.